So welcome to today's webinar, Unlocking Impact Through Blended Finance Solutions. Thank you all for being here with us, including the many members of the Food Waste Funder Circle. My name is Caroline Vance, and I'm a Director of Capital Innovation and Engagement here at ReFed, and I'm very excited to be your host today. For those of you who are not familiar with our work, ReFed is a national nonprofit working to end food loss and waste across the food system by advancing data-driven solutions to the problem. We launched the Food Waste Funder Circle in partnership with the Upcycled Food Association to help funders better understand the food waste reduction landscape, explore investment opportunities, and find partners for collaboration, ultimately bridging the funding gap that exists at the intersection of food waste innovation and capital. And I'm thrilled to have a set of panelists here with me today who know a great deal about bridging funding gaps to address social and environmental challenges. And today we're going to explore an important strategy, blended finance solutions. I'm going to kick off our discussion with some context setting. Andrew Apampa from Convergence, which is the global network for blended finance, is going to lay the definitional groundwork for our discussion. And then I'll introduce two experienced impact investors to illustrate examples of how they have worked with blended finance structures and concepts to mobilize capital for impact. Caroline Brissan from Open Road Alliance and Jennifer Louie from Closed Loop Partners. We'll then spend some time in a conversation about the preconditions for blended finance strategies to be successful, the potential pitfalls, and how to overcome them. And on a personal note, I just want to say I'm really looking forward to this conversation, having spent a number of years previously managing blended finance funds in support of the UN Sustainable Development Goals. So briefly, I would just like to make note that this webinar is presented by the Food Waste Funder Circle, which is a network designed for private, public, and philanthropic funders interested in using their capital to solve food waste challenges. It launched in December, and it currently has a set of 76 members spanning the funder types. Among other things, the offerings of the Funder Circle include a monthly deal flow report, which is currently tracking more than 140 open transactions, bi-weekly pitches from several of the organizations that are highlighted in the deal flow report, and quarterly webinars like the one today, where we focus in on various topics of interest to funders and others in the food waste space. The Funder Circle also convenes periodic networking events, and in fact, at a roundtable meeting that we held in January, the topic of blended finance came up in the context of its potential to bring together different types of funders to achieve an impact in ways that wouldn't be possible working alone. And that's what brings us here today, to take a deep dive into the topic and hopefully inspire all of you to consider how you might use the type of capital that is available to you in creative partnerships to achieve outsized impact. So if you've ever had a conversation with ReFed, with anyone at ReFed, about what it will take to achieve our national goal of cutting food loss and waste in half by 2030, this will be a very familiar statistic for you. ReFed's data and analysis shows that there's currently an annual funding shortfall of $14 billion to reach that goal, which is aligned with UN SDG 12.3. And the type of funding that's required to fill that gap includes private investment, philanthropic funding, government grants, and corporate spending dollars. In a minute, you'll hear Andrew talk about the 2.5 trillion annual funding gap between what is available and what is needed to achieve all of the UN SDGs globally, and how that astonishing number has been the catalyst for the ramp up of blended finance structures that are intended to bring more private sector money to bear in the race to 2030. So the next slide here is illustrating a framework that ReFed has developed to identify the 7 key action areas where we need to focus our efforts to make a meaningful reduction in food waste across the food supply chain. And I'm highlighting on top of it the total annual amount of additional capital required to fully implement solutions in each action area. So the annual funding gap by solution. I thought it would focus in on a few examples to illustrate how different types of capital need to work together to advance specific solutions. So first, on the prevention side of the value chain, which includes the food waste reduction solutions that are aimed at preventing the waste from occurring in the first place, we see a lot of very early stage business models that are reimagining the way the food system works today to design out the waste. And significant investment is required to develop, de-risk, and then scale those models. For example, Upcycling is an area that's been gaining momentum, with more and more startups identifying food byproducts like spent grains, fruit or vegetable pulps and rinds that would not otherwise be consumed, and processing them into new food products. ReFed estimates that an additional $219 million in venture capital and $73 million in impact first investment is needed annually to support startups in this space. And another $73 million is required in grant funding to identify, test, and operationalize new waste streams to create the conditions for those companies to expand and have broader impact. Coordination between the philanthropic and impact first funders could enable increased amounts of VC investment. Upcycling is also a solution that requires significant amounts of capital investment and working capital, financing for which can be very challenging for startups to secure from traditional financing sources. So there could be an opportunity here for philanthropic guarantees to attract private capital into the upcycling sector in a way that unlocks positive impact for everyone. Looking at the food rescue action area, by which I mean redistributing food that's at risk of going to waste to people, these solutions have mostly been executed by nonprofit organizations, so it has generally been considered more of a target area for philanthropic funding. However, there's also a notable need for large amounts of investment capital, and in this example of donation transportation, which is about improving transportation and distribution of rescued food by increasing transportation infrastructure, $98 million in additional impact investment is required annually. A coordinated blended finance approach for food rescue organizations could support the funding of the physical assets they require for recovery, while also grant funding the asset and knowledge sharing that's needed to make the solution work best and deliver the most impact. On the recycling end of the spectrum, we see examples of blended finance in action through the project finance structures that are required to advance the capital-intensive solution sets of centralized composting and centralized anaerobic digestion, such as government-funded state green banks providing catalytic capital in those structures to make the transaction appealing for private investors as well. We also see an opportunity for philanthropic or impact-first capital providers to play a role in building out those solutions, especially in regional operations, by making grants or low-interest loans to enable new projects or support technical assistance for facilities that are adopting new processes and technologies. The presence of grant or low-cost funding in these examples enables the entire project and makes it much more likely to be successful in delivering both financial returns and impact. With these examples, I hope that I've conveyed that at ReFed, we are truly excited about the possibilities of what different types of capital providers can achieve for food waste reduction when they partner together in creative ways. And now I want to turn it over to the expert and introduce you all to Andrew Apampa from Convergence. Andrew is responsible for developing Convergence's data and research activities, including building out their database of historical blended finance transactions and developing blended finance trends, analysis, and benchmarks. Earlier in his career, Andrew worked at the African Private Equity and Venture Capital Association as a research associate and at HSBC as an emerging markets equity strategist. So over to you, Andrew.
Thanks very much, Caroline, for the introduction, and good morning, good afternoon, and good evening to everybody on the call. It's a pleasure to be with you today to speak about blended finance. If we go to the next slide, I can begin the presentation by providing a quick introduction to Convergence before focusing at the question at hand on what blended finance is and the rationale for it and how it has been applied to the area of food waste and food loss today. Next slide, please. Convergence is the global network for blended finance. We generate blended finance deal flow in data, intelligence, and deal flow to increase private sector investment to developing countries. As you can see on the right-hand side of this particular slide, there are different nodes and different areas in which we focus on. As I mentioned, we produce data and intelligence from our historical deals database of blended finance transactions. We also have an online matchmaking platform in which practitioners are able to post transactions and engage with fundraisers. And also we have a design funding window which provides funding for early stage innovative vehicles in the blended finance space. But without further ado, I guess we can take a step back, and if we go to the next slide, consider the main question at hand. What is blended finance and what is its underlying rationale? Next slide, please. The story of blended finance begins with the $2.5 trillion SDG financing gap. So the UN has estimated that the annual funding needed to achieve the SDGs by 2030 is nearly $3.9 trillion, which is much greater, of course, than the estimated current SDG-focused funding of $1.4 trillion that we can see in this chart on this slide, leaving a $2.5 trillion funding gap, which greatly exceeds official development flows and philanthropic commitments. So, for example, the estimate of the total official development assistance that was provided in 2020 by the 30 OECD-DAC countries was $160 billion or $161 billion, which is obviously dwarfed by the overall size of the financing gap. And in fact, the impact of the COVID-19 pandemic over the past 2 years on the economies of developing countries has been such that the OECD has re-estimated this overall financing gap, estimating that there was an additional shortfall of around $1.7 trillion in financing because of pandemic-related financing needs and a drop in external private resources, such that this $2.5 trillion figure has actually been revised upwards to $4.2 trillion in terms of the overall financing gap. If you go to the next slide, the goal then is to think about how we can mobilize private sector resources to help address this gap. But of course, as the slide relates, there are various issues that private investors face, which impede their activity and their ability to invest in frontier and emerging markets. So this slide gives a broad overview of some of the key factors, from liquidity to a lack of knowledge to limited mandates and so on. But I guess what I really want to express is that the main investment barriers for private investors private investors active in emerging markets is high perceived and real risk on the one hand, and poor returns for the risk relative to comparable investments on the other hand. So those are really the key factors that are preventing the mobilization of private sector investors at scale into emerging markets and developing markets to help address the $2.5 to $4.2 trillion SDG financing gap that I spoke about a bit earlier. If you go on to the next slide, this just provides a bit more detail in terms of some of the risks that private sector investors face when they're committing to emerging markets. So we can see that the risks range from macroeconomic to political to regulatory risks and so on. From this slide, what I'd like to really express is the little text box on the right-hand side. The point being that if risk-adjusted returns are less attractive relative to other markets, investors will not allocate capital to emerging and frontier markets. So the key problem that we are looking to resolve in order to fill the financing gap that we spoke about a bit earlier is how can we shift the needle on investments which are perceived, or which have high perceived or real risk, or which have poor returns for the risk relative to comparable investments. That's the key problem that blended finance is looking to resolve. So if we go to the next slide, we come to the critical question: what is blended finance? Blended finance is one critically important approach to mobilizing new resources for the SDGs. So it's the use of catalytic capital from public and philanthropic sources to increase private sector investment in developing countries for global development impact. It's a structuring approach rather than an investment philosophy. So it's separate from ideas like impact investing or responsible investing. It is a way of putting together transactions such that you can incorporate different types of capital, whether impact-oriented or commercial, with the goal of having them invest alongside each other while achieving their own objectives, whether it's financial, social, or a blend between the two. If we go on to the next slide, we can provide a bit more detail. So again, what we can see on this particular slide is, again, the idea that blended finance is an approach which combines separate approaches to financing development. So you can see in this table, for example, a breakdown of aid and philanthropy, impact investing, and commercial investing. I'd like to draw your attention to the bottom right-hand side, where we can see that, again, blended finance combines all of these disparate approaches into one structure, where each actor takes on a risk-return profile that is acceptable to them, while concurrently achieving their objectives. So just a bit on the background of blended finance, how it emerged. The importance of private sector mobilization to achieve the SDGs was first borne out in 2015. And actually, Convergence was established out of the Addis Ababa Action Agenda in 2015 with the remit of building the blended finance market to attract significantly higher amounts of private capital to the SDGs. If we go on to the next slide, we can provide a bit more detail on what makes a transaction blended. So typically, within Convergence, we will be looking for three different attributes, for a transaction to have three different attributes for it to be classified as blended. Of course, if it's looking to mobilize private sector investors, it will have to have a positive overall financial return and a risk return for private investors in line with the market. As our focus is on developing markets and resolving and addressing the SDGs, we'll also look for transactions to have a positive contribution towards the SDGs in developing countries. Although again, not every participant needs to have that impact objective. And finally, we'll also be looking for the public or philanthropic parties to the transaction deploying catalytic capital in some way. So there being some kind of leverage which would ensure that the deal will happen, which would otherwise not attract private capital in any in any real sense. So here the idea is one of concessional catalytic providers being additional in terms of their contribution being necessary to help attract private sector investors into the transaction. Before we move on, I'll of course say that blended finance, from Convergence's perspective, we focus very much on the developing world. That's not to say, of course, that blended finance hasn't been used in developed markets. So that's as an approach, it's been used around the world. The focus of Convergence as an organization is very much on developing markets. So that's where the focus is for us as an organization. If we go to the next slide, this again, I can quickly touch on this. This is the idea, of course, that with catalytic funding from public and philanthropic investors, you can begin to shift the needle, addressing some of the risks that we discussed earlier in terms of high perceived and real risk and poor returns for the risk relative to comparable investments, such that private sector investors are comfortable with committing capital to SDG projects, which otherwise would not have received their attention or their investment. Next slide, please. So here, I can go into a bit of detail and spend a bit of time talking about some of the main archetypes that Convergence classifies in terms of the blended finance universe. So these are the four different structures or four different kind of instruments that we see in the blended finance market. So first of all, we can begin with concessional debt or equity, which is where public and philanthropic investors will be providing funds on below market terms within the capital structure of a particular transaction, with the goal of lowering the overall cost of capital or providing an additional layer of protection to private investors. We can also see guarantees and risk insurance, which will involve public and philanthropic investors providing credit enhancement through these instruments on below market terms. These can be event specific, as in the case of credit or political risk insurance, and overall look to protect investors against capital losses. I'll speak here quickly about those two archetypes that I've just mentioned. So concessional capital and guarantees or risk insurance are really used by catalytic funders to help create an investment opportunity with acceptable risk-return profiles for the private sector by de-risking the instrument or the investment, or improving the risk-return profile to bring it in line with the market for capital. So yeah, that's really the focus there. The latter two archetypes that we have on this slide, design or preparation funding and technical assistance funding. As you can see from the graphics below each of the descriptions, these particular instruments sit outside of the capital structure of the transaction at hand. So first of all, with design and preparation funding, the key here is that the transaction has design or preparation funding, which is funded by grants, so including project preparation or design stage grants. They're not direct investments in the capital structure, but they improve the ability or the probability of a transaction for achieving bankability and financial close. And similarly, technical assistance funds also operate outside of the capital structure to enhance the viability of the transaction and improve its ability to measure impact. Overall, blended finance, I should just say here, can only address the subset of SDG targets that are investable. So it's not a panacea for the overall financing gap. It's a single tool in the development toolbox. Analysis has shown that around half of the funding required to achieve the SDGs in developing countries can be in the form of private investment. So, the data that we have at Convergence shows, for example, that blended finance has been most commonly applied to goals like Goal 8, SDG 8, decent work in economic growth, or SDG 13, climate action, for example. And it's really less aligned or less targeted to SDGs like SDG 16, focused on peace, justice, and strong institutions. If we go on to the next slide. This provides a bit more detail in terms of how blending can be deployed, or how blended finance can be deployed. It can be applied at the project level, so public-private capital being blended within a single project or a company's financial structure. It can also be applied on the fund level, where public and private investors are pooling resources within the structure of a single fund, which then provides financing into multiple projects or companies, and so on, through funds of funds, facilities, and intermediaries, with some examples in this table on the right-hand side of some transactions drawn from our database in terms of blended finance being applied to different levels of financing. If we go on to the next slide. Now I come to the part of the presentation where there's been a lot of theory and a lot of kind of general discussion about where blended finance, or what blended finance is and how it can be used in theory. I've drawn two examples from our historical tools database of blended transactions which are relevant to the area of food waste and food loss, to hopefully illustrate some of the ideas that I've been talking about, and we can see here how blended finance has been deployed in practice. So the first one, of course, is East Africa Fruits, which is an example of concessional debt and equity in practice. This particular company is a Tanzanian food distributor, helping smallholder farmers improve their market access and reduce food wastage. So the idea here is that the company has established infrastructure to distribute a wide variety of fruits, rice, and vegetables through systems of aggregation centers and cold chain logistics, so trucks, warehouses, etc. In 2014, in terms of the actual financing and the actual structure of the transaction, East Africa Fruits received around $400,000 in patient capital from AgDevCo. And this early stage working capital enabled the company to purchase key capital equipment to establish initial operations. So yeah, an interesting example. East Africa Fruits also went on to successfully close a Series A financing round worth around $3.1 million in 2020, featuring participation from impact investors and other types of investors. If we go on to the next slide, I'll quickly go through another example here. So the Coffee Farmer Resilience Fund is an example of quite a few different archetypes: concessional debt and equity, guarantees, It's also a guarantee involved here, a design stage grant, and a technical assistance facility. So very quickly, this particular transaction finances the rehabilitation of coffee plantations affected by coffee rust disease and provides technical assistance to coffee farmers and farmer organizations throughout Central and South America. As I said, this transaction is quite complex. It had participation from many different types of funders, providing many different forms of blending. So for example, you had organizations like the Ford Foundation and Starbucks providing long-term investments in patient capital to this particular transaction. You also had a guarantee provided by USAID associated with the transaction. So as I said, I've gone through it quickly, but this is another example, a really fantastic example of how many different types of investors can be associated within a single transaction. So investors from the private sector, from different parts of the public and philanthropic sectors, each with different goals and each with different risk return requirements and so on. If we go on to the next slide, I'll quickly kind of provide a quick overview of some of the challenges that we've seen to scaling blended finance in the market. So some of the key difficulties that we faced are amongst donors, a lack of a real private sector mobilization strategy and action plan, low levels of coordination from local governments in blended finance, a lack of transparency. So particularly when it comes to ex post impact, we still struggle with getting practitioners to provide transparent data for people to help build the evidence case and people to learn from other people's experiences in blended finance. And also the overall ecosystem still being underdeveloped. So a lack of intermediaries who are able to channel capital into projects on the ground. I think I'll leave it there. I realize that I'm probably coming up towards the end of my time. But yeah, very happy to continue to discuss the market and what we're seeing in the subsequent Q&A session. Thank you.
Thank you so much for that masterclass, Andrew. That was wonderful. It's really interesting to think about the parallels between how blended finance strategies have been able to bring more capital to the table in the global South to advance the SDGs and how we might apply it to food waste in particular. In particular, your example from Tanzania feels very relevant. I have some questions for you, but I'm going to hold them while we bring our two impact investors to the conversation as well. So first, let me introduce Caroline Brissan, who leads the investment team at Open Road Alliance as the managing director. In her role, Caroline oversees the Open Road Impact Fund portfolio, providing bridge financing to social ventures at step-up moments of growth. Previously, Caroline was an investment principal at Dalberg Capital and an investment officer at Calvert Impact Capital, where she originated and managed a loan portfolio focused on sustainable trade, social enterprise, and financial inclusion. Thank you for being with us, Caroline. And please share a little bit about how you've experienced or implemented blended finance strategies in your work.
Thank you, Caroline. Let's jump into the Open Road slides. And we can go to the next slide. Great. So Open Road has a very specific investment strategy, and I'll kind of talk to you about how we got there. We provide bridge loans to eliminate funding delays and accelerate growth for impact-first companies that are addressing climate change and inequality. A key piece of our work is that for every $1 of bridge loan that we put out, we're keeping $10 of follow-on financing on track. So kind of that leverage piece that Andrew spoke to is something that we've really been focused on in our model. Next slide, please. So why do you need bridge loans? We have seen that our social sector, unfortunately, is quite inefficient. I imagine you all have seen the same domestically in some of the waste issues in food. Things happen. An example on the food side of things is we gave a loan to a company called Inspira Farms They do off-grid cold storage facilities for small and medium enterprises that are agricultural businesses. And they had a great opportunity. They got a large contract from an African government and built 10 units to put in rural Africa so that farmers could kind of take their mangoes, their blueberries, and put them in a cold storage place to reduce loss before it got to market and increase their incomes. Unfortunately, the payment on those units were quite delayed, and so all of a sudden they didn't have any cash to keep paying salaries. So Open Road gave them a bridge loan that got them from point A to point B and helped them on their way. Once they got repaid on their contract, then they repaid Open Road. Next slide, please. But I think probably what's most interesting to you all is that we started off as a philanthropic initiative. So we were founded by a philanthropist, Lori Michaels, who didn't really have any sector geography focus, but she saw things that weren't working as well as they could be in the social sector. And so our journey has been really one of hypothesis testing. We started off in 2012 making grants for one-time unexpected roadblocks when committed funding was pulled at the last minute and kind of the wheels were already turning, but a project didn't have enough money to complete. We saw that one of the key issues wasn't just that funding was gone, it was that there was just a gap in timing. And so we decided that, maybe instead of a charitable grant, let's provide a recoverable grant. At the time, we only had a donor advised fund, and so we started making recoverable grants out of that DAF. Next up, we realized we're addressing really urgent situations, and sometimes the paperwork doesn't move as quickly as we want it to on the recoverable grant side of things. And so we started up our own internal loan fund, making these bridge loans, and again, just testing our hypothesis. Then we saw that we didn't have enough money to meet the market demand. And so we formed the Open Road Impact Fund, which is our first external fund taking outside investment. Next slide, please. And so this is the real blended finance example for you all today. Making bridge loans to early stage startups. Most of them aren't profitable, but they have, kind of cash in the mail. And so we realized that we needed some sort of blended finance structure that took some of the risk away so that we could crowd in some of those more risk averse investors, but also gave an opportunity for leverage from the kind of impact first funders and investors. And so Open Road Impact Fund is structured with what we call kind of 20% subordination. So that means for those investors that really don't want to lose their money, Open Road can kind of lose 20% of our deals before any of their potential repayment would be impacted. And to give you a sense of the scale, we predict about 5% losses. So it's kind of 4x coverage. Things would have to go very wrong for their money to be hit. Of course, that comes with a trade-off because it's less risky. That means they have a lower return. So we do have this subordinated debt portion that is earning a higher interest rate, mostly family offices and family foundations that kind of recognize the risk and want to crowd in that senior debt capital. And then on the other side, from a grant perspective, every dollar that we get that does not need to be paid back or be paid interest on, that can help us lower the cost of capital of the loans that we provide to our borrowers, and also let us make loans to earlier stage companies that might be riskier. So happy to answer questions about how we got to these numbers, but I think it's a really helpful example of kind of the layer cake that comes together to make blended finance work. Next slide, please. So I want to just maybe end on leverage. I think in the blended finance dialogue, you hear a lot about how, we're just crowding in and taking the risk away from private investors. Like, why can't we get the upside too? And sometimes there's kind of that attitude out there. And Open Road sees it very differently. Our principal really loves the leverage that we have in our model. So we've made just over $50 million of loans in the last 5 years, and we've kept $600 million of follow-on financing on track. So we've got, a $5 million Series A that's being raised, but it's going to take 6 months to close. can Open Road give us a 500K loan so we can pay our team until we get there? That's a 10x leverage for us. And so when you think about the grant and you think about how our loans recycle, the Open Road Impact Fund is also a 5-year fund. And so our average loan lasts for 9 to 12 months. And so that money is going to recycle and is recycling about 5 times. So $1 of grant gets recycled 5 times over the course of the loan fund. And then we get $10 of additional impact kept on track for every dollar we lend out. And so as we think about it, our $1 million that we put in kind of first loss capital is actually leveraging $50 of impact, which is a pretty awesome bang for your buck when we think about it. And also the benefit of kind of addressing, the need more broadly than we could on our own. So happy again to answer kind of how we got to this model. But thank you, Caroline, and the rest of the ReFed team for having me here today.
Thank you, Caroline. I love hearing about your journey of hypothesis testing, and I'm definitely going to ask you about that in a minute. But I'm going to hold questions for now while we bring in Jen. So Jen is the executive director at Closed Loop Partners, an impact investment fund or firm dedicated to the circular economy, where she's responsible for managing CLP's private credit and catalytic investment funds. Prior to joining CLP, Jen spent 10 years managing emerging market debt portfolios across both the public and private markets, and has also held executive positions at organizations focused on impact investing and sustainable finance. Thank you for being here today, Jen. Please share with us your examples as well.
Great, thanks, Caroline. It's my absolute pleasure to be here with all of you today and to share more about Closed Loop Partners and how we're using blended finance structures to achieve our firm's mission of accelerating the transition from a linear economy towards a circular economy. As Caroline mentioned, I'm Jen Louie, and I serve as the head of our private credit and catalytic capital strategy at Closed Loop Partners. I joined the firm in 2020 after working abroad for the last decade as an impact investor. Next slide, please. Oh, sorry, apologies, back one slide. Thank you. So our firm was founded in 2014. Today, there are 2 core parts to our organization. It's our innovation center, known as the Center for Circular Economy, which focuses on industry collaborations, producing seminal research, and serves as an accelerator. You can move forward a slide, thank you. I think the slides are not in order. Apologies, everyone. Can you go? I'm so sorry. It looks like we lost this slide. It's okay. So one side is our innovation center, as I mentioned, and then the other side is our asset management business. Our firm is actively deploying capital through 4 investment strategies: venture capital, growth in private equity, and private credit. And it's through our private credit vertical that we are actively using blended finance type structures to make impact first investments. Next slide, please. So we have 4 core areas of investment focus. It's plastics and packaging, supply chain technology, which focuses on optimization, fashion, and of course, food and agriculture. Next slide. Of the 4 different blended finance structures that Andrew presented earlier, our team has predominantly focused on how we use catalytic capital to finance earlier stage impact first deals. The majority of what our team does is to deploy loans to projects that support the circular economy value chain. Today, our entire catalytic capital strategy is North America focused only. And through certain funds, though, we are able to expand our mandate and we're able to use hybrid instruments and or equity to support earlier stage companies and projects. The image here on the left is quite simple, not as elaborate and complex as what Caroline presented earlier, but where we would sit in the cap table or capital stack is really in the dark blue square in that image on the left side. Our core objective for using Catalytic Capital is really to facilitate the flow of capital and to optimize the capital stack for our borrowers or investees. And essentially what we want to do is to crowd in more traditional capital providers into projects that are highly impactful, but on the face of the transaction may not meet the financial expectations or targets of mainstream investors. And what we're doing as a private investment firm, I deem as being quite unique, and how we approach deal structuring is really to achieve positive impacts that's constantly evolving in our approach. And so how this works in practice, well, we leverage the flexibility that we have to structure transactions that meet the specific needs of the project or organization. So really looking at cash flows and structuring bespoke models as we go along. And this manifests through ensuring that we can provide competitive pricing, which in certain cases includes offering below market rate loans, and to specific types of entities, interest-free loans. We are able to be in a subordinated position in the cap table. We have flexibility in terms of underwriting higher LTV or loan to value loans. And we are open to what types of forms of collateral and security packages we can accept. And we actively work with the investee or borrower to see what that looks like, to be able to accommodate more commercial lenders in the cap table. And then lastly, I would say where our catalytic nature comes through the most is being accommodative during down cycle and liquidity challenges that some of these earlier stage projects or enterprises may face. You'll see that we're typically the lead in lender groups when it comes to restructuring investments or loans, which obviously helps to send a positive signal to partners. So, I think in summary, as it relates to this, it's really truly being patient capital in the capital stack and pulling as many levers as we can to accommodate that flow of capital. I'm not going to offer up an example. I feel like you've heard quite a number of really great examples now. And so I'll turn it back to Caroline to go to Q&A. Thank you.
Thank you so much, Jen. I really am appreciating the way you just illustrated flexibility by kind of rolling with that slide snafu. So thank you for the visual aid there. So I'm so happy to have all three of you here all together with some Q&A. I think where I want to start with Jen and with Caroline. We heard Andrew talk about some of the common challenges that are encountered when you're putting together blended finance structures. And I'm curious to know kind of whether that resonated with you and what in particular you have run across as you've tried to build these structures and bring in the different layers of the layer cake. So maybe let's start with you, Caroline, and then go to Jen on that.
Sure. I mean, I think the rule of keep it simple, stupid is probably the place to start. You can over-engineer these kinds of transactions, and clearly I just showed something that had 4 pieces of a layer cake, but that was all kind of built by investor demand. If you're thinking about blended finance, my recommendation would be to start with a recoverable grant. Start with providing a guarantee to a cool social venture startup that's trying to get a bank loan, and see how that feels. And then as you, again, like Open Road did, kind of test your hypothesis of the specific area of a market or failure in the market that you're trying to solve for, then you can build kind of a bespoke solution. But yeah, hypothesis, test.
Thank you, Caroline. And what about you, Jen?
Definitely agree with everything that Caroline said. I think what we've seen is really the unique challenge of spending a lot of time to design these bespoke models. We really want to, of course, as I mentioned, accommodate specific cash flow needs of the projects that we're considering. And we're prioritizing the impact that supporting an earlier stage project could actually generate. But in order to crowd in or bring other capital to the table, we typically end up going through many iterations of what that structure could look like. And unfortunately, that's hard to replicate. And it becomes it's not as cost effective essentially. And so I think what I would love to see, as we evolve and grow, just as a space, blended finance, being sort of in its nascency still, as Andrew mentioned earlier, is to share more knowledge, be more transparent about what these models are, so we can sort of fine tune exactly what does work and what doesn't, so we can build on those learnings.
Yeah, absolutely. I think somehow getting away from this trying to handcraft at scale, which is just a no-win situation. And Andrew, I guess kind of hearing what Jen and Caroline just said, would be interested to hear from you with your database of 680 different blended finance transactions that you've been tracking. What are the best practices in that regard? Are there lessons learned from these kinds of challenges that have cropped up that maybe you could share with all of us about what you can do to keep it simple while kind of accommodating all the different parties that need to be part of the structure?
Thanks very much for the question, Caroline. So yes, completely agree with the other panelists. At Convergence, we are very supportive of the idea of balancing innovation in terms of how you are putting together these transactions in the structure with the need for scale. And as was mentioned before, keeping it simple, focusing on replicable structures that can really attract private capital and institutional investors at scale. One of the things that we've seen from our data set is that structures like funds are really very prominent within the blended finance space, because obviously they have the simplicity and have the internal diversification, which would allow them to attract private capital at scale. But the fundamental point, I think, stands that what we've seen from our database is the importance of balancing the need for innovation in terms of putting together these transactions, whilst also focusing on simple, replicable structures that can really promote the mobilization of private capital at scale.
Thank you, Andrew. And Caroline, I told you I'd come back to this this journey that Open Road Alliance has been on, and I'm really interested to hear kind of what you would say to the audience members who might be kind of sitting where you all were a few years ago and thinking about getting started in blended finance. What would you say to that person? How do you get going in this?
Yeah, it's all about the scientific method. So I know ReFed has collected an immense amount of data about the different verticals in food waste, but really find your niche and the problem, and define the problem that you want to solve, and then go deep on that. So Open Road saw this, gap in the market where our role is to unstick capital in the social sector, right? And so we are agnostic to the sector or the subsector, but we're really good at providing a specific intervention. And so if you're picking food waste as your sector, maybe you have a broader suite of interventions that you offer, because it takes a complex set of solutions to unstick a certain part of this subsector. Yeah.
Thank you, Caroline. And I assume there's also kind of some other alignment that needs to be done internally, kind of as you're changing your model from one thing to another, and having that internal alignment at all levels of governance, I imagine, is probably pretty critical.
Yeah, maybe I just add is just to keep impact at its center, and so as long as the kind of top principle is how are we maximizing for impact, then the actual changing of what we do is not that difficult.
I love that. That's great. And on the topic of impact, Jen, maybe I could just ask you how you think about that at Closed Loop Partners for your catalytic funding. We heard Caroline speak about that concept of leverage, and I'm interested to know how CLP thinks about it.
So from our perspective, there are really no targets for leverage. We're really looking from an absolute value perspective to understand how a project could help to generate impact and system level change and that like incremental contribution. And so I'd say that that's how we really look at it. I think in terms of helping to build out the environment, many times we'll take the lead on due diligence and help to bring investors along to share that knowledge and expertise that we are fortunate to have in-house. And with that will then come a role whereby we are actively participating out portions of what we've underwritten. And I think just sort of working in parallel and in lockstep with other investors who are not as familiar with the space that we are operating in terms of the sectors, as an example, is how we look to generate both impact at the project level, but even at the fund level and system level. And the last thing I'll say is I highly encourage those that are interested in blended finance to reach out to any of us to learn more about it. It's the fastest way to get up to speed.
Thank you, Jen, and thank you for that reminder. I think, sometimes when you listen to a webinar and you look at slides, things like blended finance can start to feel very kind of opaque and theoretical, but it's really all about partnership and building relationships and being willing to be flexible and accommodating, as we've heard from all these panelists, while also being scientific in your method, as Caroline pointed out. And before we kind of end the Q&A here, I want to ask one question to each of you, one question for all of you to answer. And that's that, as we've talked a lot about 2030, but we're getting kind of close to 2030. And we know there's still a lot that needs to be done to meet all the international goals that we have. But what I'd love to end on is hearing about any signs of success or progress that you might have seen as blended finance has been making its efforts to get more money moving in the right direction. So maybe let's see, how do we want to do this? Maybe we'll go in order. So Andrew, Caroline, Jen.
Well, thanks for the question, Caroline. I'd say that the main positive that we have, I guess, as an industry is just that, only a few years ago, blended finance was still very much an exotic term that not many people were aware of. So I think the growth in awareness and understanding of what it is and the growing sophistication of the industry is the main thing that we at Convergence would say is a positive trend to look out that's been happening in the years since 2015. Of course, in our reports and in our publications and conversations with people in the industry, we do lay out the challenges that the sector faces. For example, around $9 billion has been mobilized on average by blended finance transactions since 2015, and this really is quite small in comparison to the broader SDG financing gap that I spoke about at the beginning of the presentation. So there are lots of challenges, and there are lots of things that we need to address in order to achieve scale. However, the main positive is to say that the market is becoming more aware of this. I think that through the work not only of Convergence but of other organizations and just growing awareness of blended finance and what it is, and conversations like the one that we're having now, the main positive that I would really point to is that people are becoming more understanding and cognizant of what blended finance is, and hopefully in the years ahead and the years to come, we can promote better blending and kind of move the needle towards creating scalable structures.
Yeah, thank you so much, Andrew, and thank you for all the work that Convergence has been doing to build that awareness. Caroline, on to you.
Yeah, it's tough to pick just one because I am very optimistic. I think, even during COVID, we saw impact investing grow, I think almost twofold in terms of the assets under management coming into the sector. And while that hasn't all trickled down to blended finance just yet, I think in the next 10 years, impact investing is just going to become investing. The average consumer is much more aware of where the money in their bank account is sitting. And I think that can only help blended finance and blended finance vehicles as we seek to kind of solve these more complex solutions.
Thank you, Caroline. Jen.
I think from my perspective, it's really the quantum and the source of follow-on capital that we're seeing pour into the projects where we've made an early, we've taken on some of that early on risk and made those investments, either loans or equity investments. And just looking at some of like the exits that some of these companies have had and the valuations, I think especially within the private credit vertical, just again, it's really who's coming into these structures as follow-on after us, and the amounts of the quantum of dollars that they're willing to put towards was what was once, sort of these earlier stage greenfield type infrastructure projects. It's all really exciting. And so I feel like the blended finance and catalytic capital is doing what it's supposed to do, which is exciting.
That's wonderful to hear. And really, again, thank you to each of you for everything that you have been doing as leaders in this space. And it is encouraging to hear that there are positive signs as we get closer to 2030. Thank you so much. I think unfortunately we're out of time for the rest of our conversation. And this has been such an interesting and inspiring conversation. And what my deep hope is that this will spark interest among all of our audience members in partnering in creative ways to advance solutions to this critical issue for our planet. So as we kind of reach the end of our time here, we would like to ask you for your help in completing the poll that you should be seeing on your screen now with 3 questions. We really appreciate your bearing with us to complete this because it does help us make our programming more useful to you. I think it's worth noting that the second and third questions are particularly aimed at individuals and organizations who have funding to deploy. And if you do answer yes to the third question about interest in connecting with other funders, someone from ReFed will reach out to you privately first to get more information before going ahead and making any connections. We are always here to bounce any ideas. If you are interested in thinking through creative ways to deploy funding to advance food waste solutions, and you heard the invitation before from Jen, if you are interested in reaching out to any of our panelists, please do so as well. If you are not already a member of the Food Waste Funder Circle and you're interested, you can learn more about our program offerings through the link in the chat. And please feel free to reach out with any questions and feedback. As always, we love to get feedback. So the Funder Circle is for funders only, but if you are a solution provider, innovator on this call, and if you are actively fundraising, please do fill out the survey that you should be seeing in the chat now. So we can include your information in our deal flow reports going forward, and that will be shared with all of our Funder Circle members that are actively deploying funding in the food waste space. So with that, thank you all so much for joining us. I hope to see you all at our next event, and between now and then, think creatively about how to use the capital that you have at your disposal to advance all of these important solutions, including food waste.